To have you back, the Federal Reserve's cut interest rates by 1/4 percentage point for the third time this year on Wednesday, while projecting one more cut for 2026. The central bank voted in a split decision to trim its benchmark interest rates to a range of 3.5% to 3.75%. The decision drew dissent in opposition directions, Kansas City Fed President Jeff Schmadmid and Chicago Fed President Austin Goolsbee prefer to hold rates steady. The Fed concludes the year with a job market that has softened and inflation remaining roughly a full percentage point above the central bank's 2% goal. In a press conference following the meeting, Fed's Chair Jerome Powell called it a challenging situation after the 2025 cuts that have reduced rates by 3/4 of a point. The outlook for 2026 is most muted. Federal officials projected one more rate cut next year, the same number projected in September. My guest is Mr. Gbolan Olojede, and he joins me for this conversation. He is a financial analyst. Thank you so much, Mr. Olojede. Good afternoon. It's good to have you on the show.
Yeah, good afternoon. Nice to be on the program.
Well, I don't know if you were expecting the Fed to cut rates, but I'm sure everyone was waiting for the outcome of that meeting. And finally, Mr. Powell came out to say, well, rates would be cut again, and even one more cut in 2026. What's your understanding of this?
Well, it's a very tricky situation that the U.S. has found itself. On one side, it wants to stimulate the economy and improve jobs. Unemployment has not been at the level that it is expected. On the flip side, it is witnessing inflation that is elevating. So it's between the devil and the deep blue sea. But on this particular occasion, it decided to err on the side of stimulating the economy via the dropping of the rates. That should be good for unemployment, should be good for businesses, but at the same time, it might not necessarily be good for the inflation numbers.
Now, considering the larger economy and what's been playing out, job situation and all in the United States, did you see this really as a step in the right direction?
You see, there is still a bit of issues with data. A lot of data that are normally used, economic data that are normally used for some of these decisions, are missing for October and half of November. Because during those periods, the economy, there was a shutdown in America, and some of the people the teams that were involved were not working. So apparently, most of the decisions have been layered on the September numbers, so it's not a total picture of what could be. But at the same time, there is pressure from the president on the direction that I would like to see. So despite the fact that there was some dissent, I think about 3 of those Fed guys voted against the reduction in the rates. But at the same time, there were more people on the side of cutting the rate. So the Fed has gone in that direction. If they're still looking at another decision in the course of this year, it will be maybe what will happen over the next 2 weeks, how the market is going to react to the current cuts in rates, as it were. But to be honest with you, it is a gamble and a very delicate line trying to balance a rate cut for the sake of strengthening employment vis-a-vis the inflation occasioned by tariff and all those import duty increases and the rest of it. It's a gamble, essentially. But maybe as the data start to come in, the data for November, data for maybe part of October as well, when those data are available, there will be a firm basis for making better decisions regarding the Fed cuts.
Like you said, the challenge remains inflation, which remains higher than the Fed's 2% target. And the job market has also cooled. You've talked about government shutdown and all. But how does this also impact on other economies surrounding the United States? You know that when the United States sneezes, all other countries catches cold. Let's look at the impact now. We know we've already had tariff issues before now, and we still have rates higher than inflation figures. So putting that together, do you think that, what do you think would happen to the larger economy? Yes.
Well, if you're talking about the economy outside of the U.S.,
Yes.
when you cut rates, you might see a situation in which some of the investment, especially the portfolio guys, might want to look for other environments where they can get better rates. So you might see a flow of some of those funds into economies where the rates are better. So for those who are looking to invest for higher return, but it is not an easy situation right now, because you also see a situation in which if this inflation pressure in the U.S. is sustained, and next year is midterm elections. Because of the midterm elections and the feelers on the streets in America about how inflation has affected pockets, the cost of grocery, the cost of living generally, we might see more of the kind of measures that President Trump was trying to put in place in the last few days regarding farmers and the rest of it. So there is an intervention that he is already doing. Maybe there will be further intervention to lower those pressure, especially the tariff-related pressure, import duty-related pressure. And if that happens, the implication is that economies that are sending products into the U.S. might be able to do more. If there is a reduction in tariff, for example, it means people can do more because the consumer can buy more. The cost will go down and the consumer can buy more. So it will be a positive for other economies, depending on the kind of intervention that the president of the U.S. may decide to do in view of the dilemma in which he has found himself. That inflation rate is still elevated, as it were.
Indeed. Even for prospective home buyers, this market has already, priced in the rate cuts, because cuts will impact mortgages generally, right?
Correct. Correct.
So how would that affect the real estate market in the U.S.?
Well, I think a cut in rate generally will have a positive effect in expanding the economy. So it means that borrowers can borrow for cheaper. If borrowers can borrow for cheaper, then the production, every sector that provides either services or goods into the economy can do a bit more, can hire a few more people to drive that expansion that is based on the fact that I can borrow more and cheaper. So it should be well for producers, whether you're in real estate or other sectors, that you can now borrow for cheaper. But the problem, that doesn't take away the inflation problem that we're speaking about. The inflation is still there. If you hire more people, if you make more money, you hire more people, there is more disposable income going out there for people to spend. The inflation pressure will remain, especially for as long as the tariff, import duty, and effect on import duty remain as it is today in the U.S. It is not fun time for the Feds in the U.S. But let's see the total picture by the time more data come in, all those missing data from the shutdown period. When they come in, it should help decision making beyond what we are seeing right now, which is, I think there's an element of just, trying to do the bid of Trump in the kind of decision that we saw recently.
All right, now let's bring it back home, because many was also expecting that our central bank would shift rates at the last MPC meeting, but we didn't see that happen. Instead, they held rates, but the asymmetric corridor and all of that was being walked on, and all of this. The most important thing for the real sector is the NPR. and we didn't see that shift in the MPR. I don't know what you were also expecting after that meeting. I've had analysts that told me that they expected a shift after that MPC meeting.
For us, it was also dicey. It is true that inflation numbers have been going down, but inflation number for December is not likely to go down. So the CBN is aware of that, and he has to be proactive in how it decides to approach the month of December as far as inflationary pressure is concerned. Even when you look at some of the other rates that have gone down, for example, the NTB, which 364-day NTB that has gone as low as a discount rate of 15 point something percent, is now inching up in the neighborhood of the 17%. So there are certain, anxieties around this period, and there are also so many other things that the CBN is looking at by virtue of the immense data that is available to it. So it was a smart move to just hold this as it were in December. In January might be a good time to see possibilities for a slight rate cut, but not in December, especially when we know the pattern of spending and the kind of pressure that comes with December in our economy.
So finally, to you, what's the outlook for now Nigeria's economy, considering the indicators that we've seen in recent times?
Nigeria's economy is on a good path. There are a lot of numbers at the macro levels that are supporting that. However, my concern is that most of those wins at the macro level have remained at the tip of that pyramid. And there is a need. The two things can happen. We can wait for market forces to make those gains, to percolate down the bottom of the pyramid. But the better approach would be to seek out deliberately intervention measures that could hasten that percolation that I talked about, so that we're not waiting unendingly for market forces to do it. As a matter of fact, market forces could be hijacked at some point, and it may not deliver what we expect it to deliver. Inclusive growth has been elusive for a long time. We cannot trust market forces to deliver it. We have to be deliberate with policies that will help us capture, consolidate the gains, and let it get further down to a fatter stratum of our pyramid.
Mr. Gbola Oladede, I must thank you so much for your time on the program Finance Experts. Always nice to see you.
Thanks for having me.